when building business credit, one of the first things we want to look at is the types of financing that are available to us as small business owners. And there's various types and combinations that are available. So what we want to do is understand exactly what each of these means. First, there's debt financing, or there's equity financing, or a combination of the two. Debt financing is your traditional bank loan. It's where you're going to receive cash, and in return, you have to pay it back with interest in most cases over a certain period of time. And it's a debt on your business. Then there's equity financing. Equity financing would be when somebody invests in your business by contributing a certain dollar amount to the business. In exchange, they're getting a percentage ownership in that business. So somebody might invest $100,000 in your business, and they get 30% of that business, and the $100,000 goes into the business in terms of being able to grow the business and get it to the next level. There's a combination of the two as well. You can have where somebody says, "I'll loan you $100,000, but in 3 years there's a balloon payment of the $100,000. In the meantime, you're making interest-only payments to me every month at a 10% interest note, for example. At the end of those 3 years, I can decide if I want to have you convert the debt to equity, and I get actual equity in the business, or if I want to maintain it as a debt and a balloon payment that's due at that time." So those are some different things that people can do in terms of financing. Investors are typically, or private lenders, will be typically the types that will look at equity financing. Obviously, debt financing they will look at too, and in most cases, debt financing is your larger bank institutions, banks, credit unions, credit card companies, those kinds of things. There's also vendor or trade credit. And vendor or trade credit is actually the single largest source of lending in the entire world. It's when one business offers services or products to another business in exchange for terms. And the terms might be net 30, it might be revolving where you're paying on a monthly basis, paying it back with interest. There's lots of factors there. And so what we want to focus in on today is that vendor or trade credit piece and understand exactly how that all works, because you want to take advantage of every possible source of financing that's out there. And if you go look at the Small Business Administration's latest survey regarding how small business owners are actually obtaining financing, 30% are saying that they use some type of trade or vendor credit. And if you're not using it, you know your competitors are, so you want to make sure you're taking advantage of that as best possible. And again, it is something that I think what we find in working with small business owners is that many of them will use the credit cards, will use bank loans, and unfortunately that what they're doing with that cash is they're spending it on things they could have used trade credit for and conserved the cash, so they used the cash to market the business or grow the business in other ways that they couldn't have used trade credit for. So making sure you utilize the types of credit that you have is a very important piece as well. Now, what is trade credit? Trade credit, again, it's the single largest source of lending in the entire world, known as business credit or corporate credit. And when I say it's like free money, it means that there's instances where people will get trade credit issued to them with a net 30 or net 45 or even up to net 90 terms. And what that means is that they'll have actually 30, 60, or 90 days, whatever the terms are. So if it's net 30, they have 30 days from the time that they make a purchase to paying back the debt. And they were able to do it in those kinds of terms with zero interest on the money. So trade credit or credit terms where it is that net type of instrument, you're getting free money for 30 days, and you do not have to pay for it. One of the mysteries behind business credit, and I would tell you it's one of the most widely used, but one of the most widely misunderstood types of lending that's out there, and it's hard to achieve long-term trade credit that's separate from you individually or separate from the business owners, and unless you follow some actual steps to help you go through the process of establishing a foundation, which we'll talk about here in a minute, to actually separate the two. Most small business owners are able to obtain some kind of credit initially, but not always are they able to obtain it long term by totally separating themselves from the business. And I think there's a couple reasons why trade credit and business credit is so misunderstood out there. And number one, there's no laws protecting the business owner's rights for obtaining credit and what shows up on the credit bureaus on the business side. There's plenty of personal credit information out there in terms of rights for the individual, but there isn't on the business side. There's really only one, which is your discrimination. You can't discriminate on the types of credit given based on race, religion, that kind of thing. The other reason I would tell you is the other factor. Other factor being compliance. It's the one area that most small business owners never really take the time to build their compliance strategy around the company and make sure that they lower the risk level for them when it comes to credit grantors wanting to issue them credit. Compliance we'll talk about here in a little bit further, but it is essentially making sure that you show up in the bureaus, show up in the directories where lenders are going to look, and the basic checks that a lender would do, you actually are passing those checks. The third reason is too many credit shops out there are jumping into the game, all online, trying to offer different types of credit programs and different things out there. And there is no really regulation of this industry to help protect the small business owner from people thinking that they know what it is that they're doing. And again, there's no third-party verification in terms of the information that they're providing to verify whether or not it's actually accurate or not. On the personal credit side, you can verify with the laws. I mean, there's lots of the FCRA law, all the different laws out there regarding personal credit. And on the business side, there isn't anything, so you really are reliant on making sure you're working with the right people and that they're providing you the right information. Now, how not to go build business credit. So if you are looking at some of these people that are out there, you want to make sure you don't do a few things. One, don't go buy good credit. Just because somebody says, I can report a trade line to the bureaus for you, just pay me X amount of dollars, and I'll make sure the trade line shows up. That's not accurate. That's not real, and it's not going to last long term. And in many cases, it could even end up in having certain people go to jail that set up a system like this. There's some companies out there that will try to sell you a trade line. Don't do it. Don't only rely on your personal credit. By relying only on the personal credit, you're putting yourself in a position where your personal credit is constantly being used, which will lower the score eventually and allow you to not allow you to go find the types of credit that you want in terms of credit loans for mortgages, maybe real estate to deals or other types of deals that you want to do on the individual side. Third, don't start without being in compliance. I've mentioned compliance already a couple of times. Compliance is really key, and it's one that many small business owners will overlook because it's not a fun process to actually go through and actually do the things you need to do to be in compliance with the lending markets. Now, to look at the differences between personal and business credit, a couple of things you really want to be aware of, and one is what types of scores are out there and the different kinds of bureaus. So on the personal side, there's a FICO or a Beacon score, and it usually ranges from 350 to 850. On the business credit side, it's called a Paydex or an Intella score, ranges from 0 to 100. On the credit side for personal, obviously your loan, lease approvals, your interest rates, insurance rates, all those things are based on your personal credit report and your personal credit scores. On the business side, loan, lease approvals, interest rates, and the credibility of your business also is looked at when it comes to the business credit bureaus and your business credit scores. On the personal side, there's really three main major credit bureaus tracking all of the information about your payment history, and it's tracked through your Social Security number. Those are Experian, Equifax, and TransUnion. And on the business side, it's D&B, Experian Business, Equifax Business, and there's several others, but those are the main ones that are out there. And it's tracked by the company's name and address typically. Not always is it tracked by the employer identification number, so it is something that you want to make sure that you're not changing your address all the time and that the address is pretty accurate, and the company name is one that's not too long. Otherwise, they can't type it into the different fields on a computer, and that will cause issues in terms of people abbreviating your names and then not matching up within the credit bureaus. Now, getting started, foundation. Number one, you want to make sure that you have a good system and foundation set up for your company. Make sure you have business licenses, that you have everything listed with the Secretary of State you're supposed to when it comes to filing your corporation, making sure that you're filed in all the states that you're supposed to be, make sure that you have all the documentation that you're supposed to, make sure that you have a phone number listed with directory assistance, that you have a physical address and location, that you don't have other people associated with your company who have been deemed high risk with the lending markets before, and making sure that your company name is actually clear as well. You don't want to go out there and use a company name in your city that somebody else had used prior that went bankrupt or something, which we've seen have happen, and people get denied credit because of it. So get started with the foundation, put those things in place, the compliance piece, and then second, make sure you register with the business credit bureaus that you need to, and make sure that you set that up properly right up front. And it's an important piece, registering with the bureaus and being in compliance. So the actual process that we go through when it comes to building business credit for somebody, number one is that compliance phase. Number two is the presence, as we mentioned, which is registering with the credit bureaus, making sure that you're listed with various directories online so that the credit grantors and lenders can see you. Then third, we're going to make sure that you apply for credit with various trade credit grantors who issue credit without the use or need for a personal credit check or guarantee, but most importantly that they are reporting to the business credit bureaus to help you build your report and score, which is the final step. Once you start building that report and score, you're out and able to go out there now and start establishing other larger lines of trade credit and start to look at other types of financing for yourself as well. And most importantly, it puts you in a better position to go out there and find other types of financing, loans, leases, credit cards, that kind of thing, because you've been put in a position where your company has some credibility behind it. Now, the types of financing that you can get, there's really 4 tiers of financing. They're all based on that foundation of the compliance and presence of the company. Tier 1 is making sure that you go out there and you're finding the initial trade credit lines anywhere from $250 up to $5,000. There are typically no personal credit checks or no personal guarantees required in this tier, and there are companies that are offering things like office supplies, computer supplies, marketing items. And then in tier 2, you're moving up the chain in terms of now these types of lenders are going to look for the fact that you've already had some trade credit established and you made payments on time, you've got a score, and you've got a decent score on the business side. And once they see that, they're willing to grant higher lines of trade credit, anywhere from $5,000 up to even $100,000 to $250,000. And these can be computer supply companies and other types of businesses out there, obviously, that can go up that high. And in some cases, they may require a personal credit check or guarantee, but in most cases, they're not. Tier 3 is where you start looking for companies granting cash lines of credit. You'll see banks, lending institutions, credit cards, and other alternative financing sources, leasing, merchant cash advance companies, and things like that. In this tier, most of the time you're required a personal credit check or a guarantee, but as just with Tier 1 and Tier 2, Tier 3, all of it reports directly to the business credit bureau, not your personal credit bureau. So it's separating your personal and your business credit. Really key. If you're able to go out there and find $100, $250, $300, or even $1 million worth of credit and financing for your business, and even if half of that showed up on your personal credit report, it could negatively impact your credit score on the personal side. So you want to make sure that any kind of credit that you're obtaining in the business all shows up on the business side, not personal. And then the 4th tier is when you start looking for investors and start looking at that equity type financing, as we talked about at the beginning, and making sure that you're working with various types of investors out there that you can show them, hey, I've already built a foundation for my company, I'm in compliance, I have a good presence, I'm using trade credit for the types of things that you as an investor don't want to spend money on, like office supplies and furniture and all those kinds of things, and that I have some good lines of credit established, or if I don't have lines of credit established, that's why I need you, the investor, to help me grow the business, and we're investing that money now into marketing or something that will help grow the company. So those are the 4 types of financing. Those are the steps for building the business credit.